Every year, millions of employees lose thousands of dollars, not because they didn't earn enough, but because they didn't know how to legally save on taxes. Imagine this: two people earning the same salary. One ends up paying 25% in taxes, while the other pays just 12%. The difference? Smart tax planning. So, in today's video, I'll show you how to save more, invest smarter, and legally reduce your tax burden in 2025. No loopholes, no stress, just strategy. Welcome back to Asset Bloom, where we help you grow your wealth, one smart decision at a time. If you're a salaried employee, you probably feel the tax pinch every payday. The good news? There are more tools than ever to help you keep more of what you earn. Whether you're in the US, the UK, or Canada, today's tax-saving strategies are designed to work within your country's legal framework, so you can save smartly without taking unnecessary risks. Let's break it down step by step. 1. Contribute to retirement accounts. The most powerful, and often overlooked, tax-saving tool is your retirement account. In the US, that means 401k or traditional IRA contributions. In the UK, it's your workplace pension or SIPP, and in Canada, your RRSP. Here's how it works. When you contribute to these accounts, that money is not taxed today. You only pay taxes later when you withdraw, usually when your income and tax bracket is lower. For 2025, the 401k contribution limit in the US is $23,000, and an extra $7,500 if you're over 50. That means you could potentially reduce your taxable income by over $20,000, instantly lowering your tax bill. Think of it this way: saving for retirement or saving on taxes. 2. Use health savings accounts, HSA, and flexible spending accounts, FSA. Healthcare costs are rising, but your tax bill doesn't have to. If you have a high-deductible health plan, HDHP, you can open a health savings account, HSA. The magic of HSAs is that they're triple tax-advantaged. Contributions are tax-deductible, growth is tax-free, withdrawals for medical expenses are tax-free. For 2025, you can contribute up to $4,300 individually or $8,450 for families. Alternatively, if your employer offers an FSA, use it for pre-tax healthcare or childcare expenses. It's a simple way to pay for everyday needs before taxes take their share. 3. Claim work-from-home and job-related deductions. If you work remotely, or even part-time from home, you may qualify for home office deductions. You can claim a percentage of your rent, utilities, and internet costs that are directly related to your work. For example, if your home office takes up 10% of your apartment, you could deduct 10% of your electricity and internet bills. The IRS allows a simplified deduction of up to $1,500 per year if you meet the basic criteria. And don't forget, equipment like your laptop, desk, or even ergonomic chair may also be deductible if used for work. 4. Optimize investment taxes, capital gains, and dividends. Investing smart isn't just about returns. It's about keeping more of those returns. One key strategy is to hold investments for more than 1 year to qualify for long-term capital gains tax, which is significantly lower than short-term rates. For example, short-term capital gains, under 1 year, taxed at your normal income rate, up to 37%. Long-term capital gains, over 1 year, taxed at 0%, 15%, or 20% depending on your income. Also, consider tax-efficient funds or index ETFs, which have lower turnover, meaning fewer taxable events. And if you have investments that lost value, you can sell them to offset your gains. That's called tax loss harvesting. 5. Take advantage of education credits and student loan deductions. Education expenses can reduce your taxes too, especially if you or your dependents are studying. The American Opportunity Credit gives up to $2,500 per year for tuition and related costs. The Lifetime Learning Credit offers up to $2,000 per year, even for part-time or online courses. And if you're still paying off student loans, you can deduct up to $2,500 in interest, even if you don't itemize. Remember, learning pays, literally. 6. Use employer benefits wisely. Many employees ignore benefits that can save them hundreds or even thousands in taxes. If your employer offers commuter benefits, you can pay for parking or transit with pre-tax dollars. If you have dependent care benefits, you can set aside up to $5,000 pre-tax for child care costs. Even stock purchase plans, ESPPs, can offer discounts or tax advantages when managed strategically. Always check your HR portal or talk to your company AS benefits team. Most people leave free money on the table. 7. Charitable donations and green credits. Doing good can also mean saving money. Charitable donations to registered nonprofits are tax-deductible, whether it's cash, stock, or even old clothes. Plus, in 2025, there are growing green energy credits for installing solar panels, EV chargers, or making your home more energy efficient. You can get back up to 30% of your installation costs through federal tax credits. And some states offer extra rebates. Every one of these strategies can legally reduce your tax bill and help you save thousands each year. Remember, tax saving isn't about avoiding taxes, it's about planning smarter. If you want to keep more of your income in 2025, start applying these steps before tax season hits. This is Asset Bloom, helping you grow your wealth, one smart decision at a time. If you found value in this video, hit like, subscribe, and share it with someone who could use a few extra tax breaks this year.